Hi guys, today we're gonna start with this topic, Introduction to Derivatives. It's a very small topic and very interesting. This covers only the small part of introducing you to derivatives, not much further. So without wasting time, we can start with the slides. Derivative markets and securities. A derivative security is a financial securities whose value is derived from another securities and characteristics of value. So there is an underlying security, maybe currency. Let's take the example of a currency. So the underlying security is a currency and the derivative may be currency forward. Okay, since the changes in currency will affect the value of forward contract also, this is known as a derivative on currency. So it is commonly known as currency forward contracts. There are other derivative contracts like options, forwards, etc. This is one form of derivative. So this other security is referred to as the underlying asset. Whatever in this the above example which I have explained to you, the currency is the underlying asset. Linear derivatives have a linear payoff that is directly related to the value of the underlying. For example, forward contracts, when the value of currency increases, forward contract value also increases and you will gain as the value of the currency moves as expected by you. Non-linear derivatives such as options involve option purchases having a right but not being obligated to buy or sell the underlying asset at the stated time in the future. See, non-linear derivatives have a particular option and this is non-linear in nature, in the sense the option holder can exercise his right as a forward contractor and also he can deny to exercise the option. So in that sense he may be entitled to profit, but losses he will only suffer up to the option premium that he have paid while purchasing the option. So that's all for this introduction. We'll move on. So there are two types of market in derivatives, the over-the-counter market and exchange traded market. The primary difference between this is traded in stock exchanges, etc., at the exchange traded market, but the over-the-counter market is done through phone. If you see the typical differences between this, I'll read one by one. The end users and dealers would contact each other directly through a broker. Dealers frequently use intra-dealer brokers to transact with others through electronic matching by computers. Typically involves much larger trade. Terms are set by the exchange. See, in the case of over-the-counter markets, it is mostly done for large volumes of trade rather than small. For exchanges, it does more larger and smaller trades, but it has lot size. If you want to do 10 crores of trade, you can do 5 and 5, and you can also do 10 here, but usually people prefer a much uh, personal touch when you go for a larger trade. Terms are not set by the exchange. Here terms are set by the exchange. A new regulation since the credit crisis of 2008 has come. Since then there has been new regulations in this OTC market. Anonymity is greater. Here no anonymity is there. Anybody can know who is trading with. OTC trading has more credit risk when it comes to non-standardized transactions. Exchanges are organized in a way that credit risk is eliminated. Okay, so credit risk means here when a person by a phone tells us he'll settle a contract on a particular day and he doesn't settle, that is known as a credit risk. OTC, it is there. Exchange traders, it is not there, since exchanges will guarantee the payment, and if the other party fails to pay, he will have some remedy against the other party and he will pay us the exchange. So this is what happens. This is what the major difference between OTC and exchange traded markets. Options, forwards and futures. A call option gives an option holder right to purchase underlying asset by a certain price. Purchase a certain asset by a certain specified date at the exercise price. The put option gives the option holder right to sell the underlying asset by a selected date at an exercise price. American options will be worth more than European option when the right to early exercise is valuable, and they will have equal value when it is not. So options have there are two types of options mainly: call option, put option. Call option has gives a whoever purchases call option will have a right to buy an asset at a particular date at a particular price, which is known as the exercise price. For put option, we have a right to sell at a particular price at a particular date when you purchase a put option. Two types of options: American and European. American option can be exercised before the specified date, and European option can only be exercised at the specified date. American options for that matter is more costly. And here this is forwards. A forward contract is a contract that specifies the price and the quantity of an asset to be delivered sometime in the future. So it can be on commodities, currency, interest rates, etc. So what happens is we contract, we bet on the prices. If it falls, if it goes up, means gaining or losing, as well. Means there are sell forward contracts and buy forward contracts. Based on the contract, will be losing or gaining. So it's basically a bet. And forward contracts are often used in a foreign exchange situation, as these contracts can be used to hedge foreign currency risk. This happens because if we have a foreign currency remittance due on a particular day, they will be contracting with another party, maybe a bank or AD category 1 bank. We will be contracting with them to give us that buy forward contract on that particular day, so that on a particular currency, so that the risk of fluctuation we don't suffer. We'll be telling him, give us this $1,000 on 23rd March at the rate of 72. Let the rate be 74 or 75, we'll be losing, losing 2-3, means gaining 2-3 rupees. But if it is 68, we'll be losing also, but that we don't care. Hedging is only for eliminating the risk, not for eliminating the losses. So future contract is more formalized, legally binding agreement. This is just forwards, which is legally binding and exchange traded. Coming to call option payoff. Call option payoff, the payoff of call option is to the option buyer is calculated as follows: CT, payoff of call option, is equal to maximum of 0 or ST minus X, because the maximum that we can earn is strike price, stock price at maturity minus the strike price of the option, which is being explained in the next slide. So if you see, let me take the pointer. So if you see, this is the premium paid for this is the premium received for stock option. This is the premium received for stock option. This is the premium paid for stock option, stock call option. So if you see, when we pay the premium, we are at loss of this much, and we have bought this call option. As the stock price increases, the value of call increases, and we'll be gaining this much profit. And as the stock price increases, we'll keep on gaining. So for option seller, this guy has sold, he has got this much amount with him, and since the stock price increases, the call option value deteriorates and he will fall into losses. So this is how stock option, the call option works. So put option is similar to call option, but there a right to buy is given, and here a right to sell is there. So put option is given by calculated by max 0, X minus ST. X is strike price and stock price at maturity is ST. Okay, so the price paid for put option P0 is referred as put premium. Payoff of the buyer will be P1 PT minus P0, and seller will be P0 minus PT. So that's just numerical terms. So this is a graph that you need to learn. So this is a premium that we are losing, so that we have to give to purchase a put option. So since we have a right to sell, as the stock decreases, we will be gaining. And since this guy has given us this option, he is an option seller, he will be gaining at the beginning. At the stock price decreases, he will be losing. So since he has a obligation to buy, we have a right to sell. So this is how the graph works for put and call options and the maximum prices. Forward contract payoff. Okay, forward contract payoff is simply denoted by ST minus K, where K is delivery price and spot price, ST spot price is maturity. This is for normal long position. For short position, it is K minus ST. If you see the graph, it is not visible here, but for long position, it will be keep on increasing, and as the stock price increases, and short position, it will be decreasing. Derivative traders. So hedges typically reduce their risk in forward contract or options. Forwards neutralize risk by fixing the price the hedger will pay or receive for underlying asset option contract. In contrast, are more of an insurance policy that require the payment of premium but will protect against downside risk and keeping some of the upside, which has already been discussed. Speculators or these hedges are people who wants to safeguard from a risk and just keep it real, so they are hedges. Speculators are effectively betting on future price moment. Arbitrages take offsetting position in financial instrument to lock in riskless profit. So mainly hedges wants to eliminate risk, speculators want to earn profit by taking risk, and arbitrages wants riskless profit and they exploited the prices and takes offsetting position. Offsetting position in the sense buy and sell position due to mixed pricing. So if say in national stock exchange a stock is priced at 100, and in Bombay Stock Exchange a stock is priced at 90 rupees. Some guy will buy it 90 rupees from Bombay Stock Exchange and sell to National Stock Exchange as 100 and make 10 rupees profit. It is practically we will not see that in practical life, but there are mispricings in different markets, and arbitrageurs are people who wants to take benefit of that. Hedging strategies. An investor or business with long exposure to an asset can hedge position either by entering a short futures contract or buying a put option. So both will give the same result. Short futures contract means we will sell on a given day, and buying put option means having a right to sell. So and in we have a long position. Since we have a long position on a given day, we can sell at a given price for forward contract, and or we can sell at a given price or lesser than that, uh, or more lesser than that for a put option. An investor with short position of an asset can hedge exposure by either entering into a long futures contract. Since you have a sell position in an asset, long futures contract means buying that asset on a future date, or buying a call option, that is also right to buy on a future date. Speculative strategies. Okay, speculative strategies is the strategies that is commonly for making profits. Speculation means making profits. So the motivation for using futures in speculation is that limited amount of initial investment creates significant leverage. See, if you are expecting a stock to go higher in value in coming days, if you buy that stock, it will take a lot of investment from you. But futures can be purchased by giving a very less margin money. We don't have to purchase the stock as such. So that is the motivation for using futures. The amount of investment required for futures is the amount of initial margin required by exchange. That's already discussed. Future contract can result in large gains and large losses, and contract payoff are symmetrical. Options differ from futures is that options have asymmetrical payoffs. Gains can be quite large from going long option, but loss from option position are limited to option premium. But don't be misguided in the sense that if you go long will get more profit. No, option premium will be priced in such a manner that option seller will not face the losses. Okay, so but in theoretically you can gain a lot of profit by buying a call option, but by selling it you will limit yourself to the premium. Thank you. So that's all about speculative strategies. Arbitrage opportunity. Arbitrage seek to earn risk-free profit due to mispriced securities in the market. He can discover that by his analysis, and he can take offsetting position, sell and buy position, and offset that position and make profit today. Risk from using derivatives. If our the bet one may start going in a wrong direction, it can be catastrophic. Yeah, that as I have said. Additionally, the risk exit that trader with the instruction to add a hedge position make use of derivatives to speculate due to the massive potential payoff of speculations if speculation succeeds. So consider something like a big company having a very good export turnover. So there are a lot of remittances that is going to come. A fund manager is allowed to hedge these positions. Consider a scenario when he starts speculating on those. Okay, the losses that company might suffer will be very large due to the large volume of exports. So these type of risk is known as operation risk when it is done in an unauthorized manner. There are companies which permits that,